You've been told the same lie your entire life. Invest your money, let compound interest do the heavy lifting, and eventually you'll retire a millionaire. We've all heard this advice from traditional financial gurus, our parents, and standard textbooks. It sounds completely foolproof. But what if I told you there's an invisible tax loophole, one that Wall Street actively uses to siphon off your compound interest right under your nose? The reality is, the financial system is often designed to keep retail investors on a treadmill, running faster just to stay in place. They don't talk about it on traditional financial news, and your bank definitely won't warn you about it. Why? Because the very institutions holding your money are the ones benefiting from your ignorance. Today on Finance Deconstructed, we are exposing the silent wealth killer draining your portfolio and showing you the exact loophole the 1% use to plug the leak and keep their money growing. Meet Dave. Dave is doing everything right. He lives below his means, he saves 20% of his income and diligently invests it into a popular, actively managed mutual fund. He checks his portfolio at the end of December and sees a 10% return for the year. Dave is thrilled. He thinks his money is compounding perfectly, and he's already dreaming of that early retirement on a beach. But then tax season arrives. Dave goes to his mailbox and pulls out a 1099 DIV form. He opens it up and gets a form in the mail saying he owes taxes on thousands of dollars of capital gains. He rubs his eyes, thinking it's a mistake. But here's the crazy part. Dave didn't sell a single share. He didn't touch his money. He didn't transfer a single dime to his checking account. So why is he being taxed like he hit the jackpot? Welcome to the phantom tax. When you invest in an actively managed mutual fund, you aren't just buying stocks. You are paying a Wall Street manager to trade them for you. And these managers trade a lot. They are constantly shuffling the deck, chasing returns, trying to beat the market, or doing what's called window dressing at the end of the quarter to make their fund look artificially successful. Every time they sell a stock inside that fund for a profit, it triggers a capital gains tax. But Wall Street doesn't pay that tax. You do. By law, the fund has to pass those capital gains distributions down to the shareholders. And here is where it gets truly infuriating. Even if the fund actually lost value that year, if the manager was doing a lot of buying and selling, you get stuck with the tax bill. Imagine watching your portfolio drop by 15% during a rough market and still having to pull cash out of your own pocket to pay the IRS for the manager's internal trading. It is the ultimate financial slap in the face. This is tax drag. Having to pay taxes year after year on money you never even withdrew interrupts your compound interest. It's a leak in your wealth bucket. Think of it like trying to drive a high-performance sports car with the parking brake securely engaged. You're putting in the fuel, your hard-earned cash, but the friction is constantly slowing you down. Over 30 years, this invisible tax can literally rob you of hundreds of thousands of dollars in potential growth. It is the difference between retiring at 55 with absolute freedom or working until you're 70 just to make ends meet. So how do the ultra-wealthy avoid this? They understand that true wealth isn't just about what you make, it's about what you keep. They don't let Wall Street churn their accounts. They use a completely different vehicle: exchange-traded funds, or ETFs, and index funds. Unlike active mutual funds, ETFs are structured differently. Because they just track an index like the S&P 500, there is very little buying and selling. The investments sit still, allowing the market to do the work. And due to a specific legal tax loophole called in-kind creation and redemption, ETFs rarely pass capital gains onto you until you decide to sell your shares. Instead of selling stocks for cash inside the fund, which triggers a taxable event, ETF managers simply swap baskets of stocks directly with institutional investors. No cash changes hands, meaning the IRS can't step in to take a cut. The rich also shield their compound interest by utilizing tax-advantaged accounts like Roth IRAs. Inside these accounts, compound interest is trapped in a vacuum. You pay taxes on the initial seed money, but the harvest, decades of explosive compounded growth, is completely yours. No tax drag, no leaks. You keep exactly what your money makes, completely tax-free. Wall Street makes billions off retail investors who don't understand the tax drag of active management. They rely on you looking the other way while they skim the cream off the top of your returns. But now you're not one of them. You have the playbook. Stop paying the phantom tax. Log into your brokerage today, review your holdings, and look for those actively managed wealth drainers. Switch to low-cost ETFs, utilize your tax-advantaged accounts, and take your compound interest back. If this video changed the way you look at your portfolio, hit the like button and subscribe to Finance Deconstructed. We expose a new financial secret every single week to help you level the playing field. Until next time, keep compounding.